People have been investing in gold for thousands of years. Other asset classes have emerged, ownership structures have evolved, but the notion of holding physical gold as a store of wealth has endured the test of time. What is it about this commodity that still appeals to investors today? And how can we model its price behavior? All of this and more in this episode of Commodity Exchange.
Welcome to the second episode of the Commodity Exchange, a podcast where we bring to you insights from the world of commodities. Whether you're an investor or just want to learn more about the topic, this podcast is for you. I'm Nitesh Shah. I'm the head of commodities and macroeconomic research here at Wisdom Tree.
And I'm Mubin Tahir, Director, Macroeconomics Research and Tactical Solutions at Wisdom Tree. Before we begin, I do need to state the following. To clarify, the views and opinions expressed in this podcast are those of Wisdom Tree and are subject to change. Anything we present in this podcast is not intended to be relied upon as a forecast, research, nor as investment or tax advice. The information and opinions expressed in this podcast are not a recommendation, offer, or solicitation to buy or sell any securities, and reliance upon them is at the sole discretion of the listener. Please remember, past performance is no indication of future results. So, as always, we will start with a market recap, what's been happening in the world of commodities, some key highlights. And in this episode, I will start by highlighting three commodities which had some interesting developments, particularly in the month of April. So let's talk about those three commodities. Starting first with carbon. And when I say carbon, I'm referring to European Union carbon emission allowances, abbreviated as EUAs. And this essentially is the price that you have to pay if you emit carbon dioxide if you are a regulated entity in Europe. Now, on the 18th of April of this year, 2023, the European Parliament approved key components of the Fit for 55 legislative package. Now, the Fit for 55 package is designed to reduce greenhouse gas emissions by 55% by 2030 compared to 1990 levels, hence the name Fit for 55. Now, for the last 2 years or so, there have been very active negotiations going on between the European Union Parliament, the European Council, and the European Commission. And we are now getting to a stage where the legislative package is close to becoming law. Now, the entire aim of this pursuit is to make it more punitive to emit greenhouse gases. And the goal is to include more entities into the regulation, tighten loopholes, and limit the supply of allowances. So, in the last 2 years, as we've had developments in this front, the price of European Union allowances has been trending upwards generally in anticipation of the developments becoming part of law. So, progress on this front is certainly a positive sign. That was commodity number one. Let's now move to commodity number two, and that is tin. The price of tin recently reacted to news emerging from potential supply disruption in Myanmar. Now, Myanmar is the third largest producer of tin worldwide, and recently, due to political reasons, there is news emerging that there could be potential supply disruption in the coming months. Now, tin is a metal that is used in soldering, and soldering is a process which binds different metals together. Very important, particularly in the energy transition, as more metals become relevant for all sorts of green applications, electronics, and so forth. And China is heavily reliant on Myanmar for its tin imports. So developments of potential supply disruption are very, very important in the price movements of tin. In recent times, China has been looking to reduce its dependence on Myanmar, but it still remains heavily dependent on the country. Also interesting to note that in recent years, tin has exhibited large price fluctuations compared to other industrial metals, with its rally in 2021, 2022 outpacing several other industrial metals, but that was followed by an equally sharp pullback in subsequent months. So that was commodity number two. And commodity number three, which had interesting developments in the month of April, let's talk about sugar, an agricultural commodity which actually soared in April and has been soaring since the start of this year. And the reason for this was that lower than expected supplies from India and Thailand, India being the second largest supplier of sugar worldwide, and Thailand being the third largest supplier of sugar worldwide. So, lower than expected supply from these two countries is providing tailwind to sugar prices. And at the end of April of this year, sugar prices hit their highest level in almost 12 years. And the rally really emphasizes how unique each commodity's story of demand and supply really is. So, with that, that wraps up our market recap, and we can now move towards the main segment, the main topic of this podcast, investing in gold. So, I want to start, Nitesh, by just mentioning a quote before we dive into the discussion. I saw this on a website, and it's the website of Express Gold Refining, and I found this quote very interesting. It said, "Wars have been fought over gold, love has been expressed with gold, and gold has changed the landscape of civilizations and the world." I found out that very interesting how those angles were being highlighted. But of course, the idea of physical gold as a store of wealth, even a symbol of power, has been around for thousands of years. By most accounts, ancient Egyptians were the first to smelt gold in the year 3600 BC. And needless to say, a lot has changed since then in the world of finance and investing. But the idea of investing in physical gold has endured the test of time. But the notion of investing in gold is interesting to investors today. So we want to start there, Nitesh, and we want to discuss really the basics of why investors would be interested in investing in gold. So talk us through the case for investing in gold as an asset class.
So, Mabeen, I totally agree with you. Gold is a very versatile asset, and not only is it versatile, but it has these behavioral characteristics that no other asset class really has, and that's what makes it a perfect diversifier for any portfolio. And with sort of the basics of diversification theory, the only free lunch you get in any investment is diversification, and the less correlated an asset is with others, the better it is in that regard. So gold does several things. It acts as a really nice hedge against inflation. When inflation is really strong, as we've seen in past decades, notably in the late 1970s and early 80s, uh, gold is one of those assets that really performs really strongly in those environments. So a hedge against inflation. Um, it also acts as a very defensive asset as well. When people are worried about financial dislocations, when people are worried about um, economic stress points, when the economy is weakening, we tend to find gold prices rise. In that way, it competes a lot with, say, fixed income assets like treasuries or government bonds. So defensiveness is also another trait. So gold is one of these assets that does well in both extremes. When the economy is really strong, which often generates a lot of inflation, gold prices do well. And when the economy is doing badly, and you're seeing, uh, you know, recession risk, financial market risk become elevated, gold also does well then. So both at both extremes, gold does perform strongly. Also, it acts as a geopolitical hedge as well. When a lot of investors are worried about war risks, are worried about the implosions of various countries, you tend to find gold prices rise. Um, Geopolitical risks tend to move gold prices very temporarily. We saw that last year with the outbreak of the Ukraine war. We saw gold prices rise. It didn't last forever. Gold prices came off after a while, but for temporarily, it acts as a nice hedge for those kinds of risks. So gold is quite versatile, but it also it behaves very differently, and that's why it makes a great diversifier for a portfolio. Now, I guess one of the other questions is worth considering is how to invest in gold, because gold, while you can just think about the metal in of itself. Yes, you can buy a metal and store it physically, keep it in your own property or in a vault. That's one way of doing things, but there are other ways of um, getting gold exposure. Um, One way is through futures markets, so getting contract exposure to gold, where the deliverable uh, is physical gold. That's another way of getting price exposure to gold. Um, and in the physical market, there are many different ways of accessing physical. I mean, you could even go down, in the retail market, you can even buy very small gold bars, or even pieces of jewelry can be thought of very broadly as an investment. But for most people who are trying to access gold in a effective way, when investing physically, it means the 400-ounce bars. Now, that is quite an expensive endeavor for most people. And if they want to access um, gold bars or get exposure to gold prices in other ways, there are exchange traded products also based on the physical. Typically, investing in physical gold tends to be much more cost effective than investing in gold futures. Um, One of the issues with investing in gold in futures markets is that most futures markets involve some sort of contango on the futures curve. And what I mean by that is that the price of a gold contract for delivery in a couple of months' time tends to be higher than the price of gold today. And with the passage of time, the contract for delivery in 2 months' time becomes a contract for delivery in 1 month's time, and then soon enough it will become the spot price. If the curve shape doesn't change at all, what you find is that the price uh, of the contract that was originally 2 months out will become converged to the spot price today. That means you're getting a drag on price performance. That contango in markets is something that's built in, and it's reflective of the storage costs of gold, plus um, foregone interest rates, and a few other risk factors. Investing in gold physically, even incorporating the vaulting costs and insurance costs, typically tends to be lower than it tends to be more better than investing in the future once you incorporate that roll drag.
Nitesh, in the world of equities, there are well established valuation models. Now, people can disagree with what inputs you put into those models and what you get out of those models, but people tend to agree on the tools that get used in valuing those types of conventional asset classes like equities and bonds. But with commodities, it isn't always as straightforward. So having a model to explain the price behavior of a commodity is quite unique and it's quite special. But you have built a model that helps explain the behavior of gold. So tell us about it.
Yeah, you're quite right. Gold um, doesn't really behave like most of the asset classes, and therefore modeling its behavior is, it's a bit of a challenge. And gold isn't a yielding asset, so you can't use things like discounted cash flows. And from our analysis, the movement of the physical supply and demand doesn't have a huge bearing on price either, unlike most of the commodities. So, looking at gold, understanding its price behavior, and trying to provide something useful for investors, and the other interested parties to understand gold, is quite is quite a challenge, and it's a challenge that we undertook uh, in 2015, so close to um, 8 years ago. We put together a model, and the idea here was that there are many things that people talk about that influence gold prices, and if we were to believe that every single one of them were important, then we'd be, changing our gold price forecasts every 2 minutes because something else is new is happening. People talk about great monsoons in countries like India, which is a large farming based country, and when you have a monsoon in such a country, that means your crop yields will be better, and then farmers have more money to spend on gold, and therefore gold prices should go up. I mean, you'd see sort of these sort of convoluted um, explanations, and you'd be forever chasing a new gold price every time something moves. So what we did was to get as many time series of data that of things that people talk about that move gold prices and put them into our model, and we could condition for pretty much everything there. So when you've got and we started the exercise with somewhere between 20 and 30 variables. When you're putting all those variables into a model at the same time, only the statistically most significant will survive. And in doing so, we ended up with a very parsimonious model with just four major variables that drive gold prices. And they include the US dollar. So as dollar appreciates, that tends to be bad for gold prices in dollar terms. Um, Inflation is another important variable for gold, as we've just discussed earlier on. As inflation rises, that tends to be gold price positive. Also, we talked a little bit earlier on about gold being, an alternative to other defensive assets like U.S. Treasuries, and so U.S. Treasuries actually end up being a strong influencing factor for gold prices. So as Treasury yields rise, as in bond prices fall, we tend to find gold prices fall as well. And the very last thing that's in our model is speculative positioning in gold futures. And we use that as a measurement for investor sentiment towards gold. And sentiment tends to play a very important role in gold price behavior, and that tends to capture some of those geopolitical risks or other risks that we discussed earlier on. So with those four variables in mind, we can capture almost 65% of gold price movement, which is very strong. And the model is quite effective. I mean, it's hard to show a chart here on a podcast, but encourage you to look at our website. We have, if you look at the outcomes of our model, um, turning points tend to be well captured by our model, and so does a direction of gold prices by our model. So we've been running this, for close to, as I said, 8 years now, and we find it a very effective tool in describing gold prices' historic behavior, but then we can also use it as a tool for projecting forward. The model in of itself doesn't project forward, but what we can do is create a gold price that's consistent with our macroeconomic view of the world, given the context of the variables that go in are mainly sort of macroeconomic by nature. Um, so that's some of the ways in which we use this model. But maybe before thinking about forecasts it's good to reflect a little bit on the short term past. Um, and we can use this model just to explain, where we've gone through in gold prices recently. And when I say recently, let's take the last few years. Um, we saw with the outbreak of the pandemic in 2020, gold prices got quite a substantial lift. That's a period of a lot of uncertainty. Once again, people flock towards gold in times of uncertainty. Um, we hit peak gold price around August of 2020 in nominal terms, when gold prices hit $2,060 per ounce at around that time. Um, and during that time, we had a period of monetary largesse. Um, Central banks were expanding monetary policy, pumping lots of liquidity into the market. And one of the other features of gold is it is almost like a pseudo currency. A lot of people look at gold as an alternative to fiat currencies like the dollar, euro, yen, and other currencies that are managed by central banks. If those other alternative currencies, fiat currencies, are being, you know, debased by the central banks, by their central banks expanding their monetary supply, people often look at gold as the alternative where the monetary supply can't be expanded at will, and therefore go into that. So that's why 2020 was a very strong year for gold prices. 2021 was also quite strong, but then we started to see gold prices slide, especially in 2022. And that came on the back of the Federal Reserve and other central banks was withdrawing a lot of that quantitative easing that they put into the market with quantitative tightening. Tightening of their balance sheets would mean less monetary debasing. All the fears that were in place in prior years were being taken away. And we saw bond yields rise substantially. So we saw a massive bond sell off, and we saw the dollar appreciate extremely strongly. At the same time, we were living in a year of inflation being at multi-decade highs. And some people looked at gold and said, "Well, why isn't gold doing more in this environment of extremely high inflation?" It's the other things that matter at that point. Well, everything matters, but yeah, they all need to be taken in combination, and therefore that bond sell-off and extremely strong dollar acted as headwinds against the tailwinds of high inflation. That was 2022. But coming into 2023, um, the market's looking a lot more optimistically at central banks making that pivot once again towards loosening interest rates. And therefore, the dollar has stopped appreciating like we saw in 2022. The bond markets have largely settled as well. And once again, people are worried about other risks resurfacing. We had a banking, a lot of stress in the banking sector, the collapse of SVB Bank, and also Credit Suisse being bought out by UBS. When people are worried about these kinds of risks, once again, gold becomes a place to go to. So, a couple of the things that our model has helped us explain in the real world.
Nitesh, it's interesting that monsoon rains in India didn't make the cut in your final model, but crucially, not on the basis of your personal opinion, but lack of statistical significance. So, thanks for explaining the context there. Now, back in the day, I, from my investment consulting days, Nitesh, I had a colleague who had this pet phrase, and it was a tongue-in-cheek expression, and he used to say it's only a model when we used to work with things like stochastic models and whatnot. Um, yes, it's only a model, and nobody has a crystal ball for explaining the future. But of course, models are immensely useful in creating a framework to ultimately facilitate decision making. And this is particularly true if you can uh, illustrate the model with forward looking scenarios. So, you mentioned how you look forward and use the model to look forward for gold prices. So, what scenarios do you have, and how does gold behave in each of those scenarios?
Yeah, Mobin, I fully agree with you. A model is only as good as the inputs you can put into it, and that's what makes goal forecasting very difficult. Because I need a good forecast on inflation, I need a good forecast on treasury yields, I need a good forecast on the dollar, and then investor sentiment. I mean, forecasting investor sentiment is a tough job, but once again, the model is there to make a gold price that's consistent with our view of the world elsewhere. Um, so, and that's the nice thing about model. It doesn't have to just be my view of the world. I can take anybody's view of the world and plug that into the model and work out gold prices that are consistent with those. So, one of the first things that I like to do is look at market consensus. If you take a survey of economists and you take the average of their opinions, that's one way of looking at what could be a so-called consensus view on gold, right? What's the view on gold that's consistent with everybody else's, with the average view on where the economy is going? So if I do that, and bearing in mind the consensus expects a Fed pivot, Federal Reserve change in monetary view, sort of around the middle of this year. It could be as soon as this week could be the very last increase in interest rates from the Federal Reserve. And then we may see even potentially rate cuts during the back end of this year. That sort of Fed pivot could lead to the dollar being pretty much topped out, and dollar depreciation for the rest of this year. Also, treasury yields could also be pretty much close to the end of their increase. And if that happens, combined with a conservative view of investor sentiment towards gold coming down a little bit from where we are today. So, putting in context, today we have speculative positioning, net speculative positioning in gold futures at just over 200,000 contracts net long. If we bring that down to sort of long term historical average of closer to 100,000 contracts net long, putting all of these sort of things into my model, I could get a gold price that's around 2,285 by Q1 2024. So that's what I call the sort of consensus view on gold. Now, we can play around with that, as I said. So, what if consensus is wrong? What if um, the central bank, the major central banks, the Fed included, um, what if their rhetoric that they want to kill inflation at any cost um, is right, and they continue to raise interest rates until it's undoubtable that that inflation has gone? That could potentially drive economies into recession, which would typically be good for gold prices once the recession arrives. But there would be that period before the recession has been fully induced, where inflation could be still lingering there. But we could see bond yields rise substantially more, and we could see the dollar potentially appreciate more if the Federal Reserve is raising interest rates at a higher um, at a higher pace than other central banks. Um, Now, if we see, say, dollar sort of appreciate to say, um, you know, from where we are right now, so around 100 and the dollar basket at 102 to go to say 110 instead of depreciating, and we see nominal yields on on treasuries rise to say 3 8 8%. That could drive gold prices at the end of that sort of exercise. We could see gold prices fall to around Just get the right number. Yeah, around $17,000 per ounce. On the flip side, if we were to see uh, the Fed act more decisively, acknowledge the fact that inflation may actually be falling a lot faster than what they're currently got in their models. If you bear in mind the fact that other independent housing indicators like the Case-Shiller numbers look like housing prices in the US are falling a lot faster than what's in the PCE deflator. Also, if we acknowledge if the Fed acknowledges the fact that outright monetary contraction, which we're seeing right now, is something that could drive deflationary pressure in future years. What we may find uh, with with more aggressive cuts at the back end, we could find gold prices rise all the way to 2,500 by Q1 2024. So a couple of different scenarios there, but I'm sure reality will be somewhere in between. But at least we can play around with these scenarios as they occur.
You've highlighted the important role of central banks in the conversation on gold, but I'm keen to explore that point a bit further. In the past, we have had monetary systems where the supply of money has been linked to how much gold a central bank possesses, also referred to as the gold standard. In today's world, of course, currencies don't quite work that way. The monetary system works on trust rather than convertibility into physical gold. Yet, we see that central banks still buy gold, and they have been buying record quantities of gold in recent times. So, tell us why that is the case.
Yeah, that's a great point to raise. Yes, gold has had that pseudo monetary status for several millennia, and at points it has had a formal monetary status. These gold standards that you talk about, basically, the idea behind them, the central banks basically um, can only issue its own currencies if it's backed by gold. Now, even historically, um, when central banks were operating gold standards, it wasn't the entire monetary base that was backed by gold. It tended to be partially. And then, that's when we think about individual central banks. There were times when you had a system of central banks um, kind of having a currency regime that was um, worked in with association with each other, so like the Bretton Woods for example, which was a form of a gold standard, but it was only one major central bank, the US's central bank, that was backing its monetary base with gold, and then every other country would back its currency with the dollar. So there's almost a pass through that every other currency is backed with gold, but it's sort of through that dollar intermediary. But even then, it was only partially backed. Now, gold doesn't, the Bretton Woods system and gold standards have all gone away into the past. There's no, um, none of those systems anymore. We work in a world of, a fractional reserve banking system where central banks basically create the high-powered money, and they can issue currency at their will. Um, but also, what a lot of countries also acknowledge now is that the currencies that individual central banks issue, there's limitations on the usage of those. And that became really apparent last year when when Russia was put under sanctions. Its ability to use dollars uh, and other currencies became severely limited. Now, central banks still treat gold as a pseudo currency, and they hold stores of gold. And very often, the way in which those things are looked at, they're looked at, they're almost accounted for as an alternative to other currencies that they hold on their balance sheets. And you'll see that the big developed world countries, their central banks hold quite a lot of gold on their balance sheets relative to other currencies. And they've held them there just through legacy. A lot of these central banks have actually sold down their stocks of gold in past decades, but still relative to the other FX reserves, they're still quite large. Now, more recently, and I say recently, the past decade or so, you've seen developing countries' central banks buy more and more gold, and increasingly they're putting more gold into their balance sheets that competes with the levels that are held by developed central world banks. And going back to that point that we saw last year, the fact that a country can be under sanction and therefore can't use or effectively use the currencies of other countries easily has meant that a lot more developing world central banks have been looking towards gold, which no other central bank can control, um, as the alternative. So we saw really strong purchases from, say, the Turkish central bank last year, um, the uh, the People's Bank of China, which hadn't been buying gold for a number of years, or at least hadn't been reporting gold purchases for a number of years. Last year started to increase its gold purchases, and by November last year they started reporting purchases once again. Um, uh, and more recently, we've been seeing uh, a much wider set of countries purchase gold. Even last month, so last reporting month, which was month of February, reporting on this a little delayed. We saw the Monetary Authority of Singapore actually buy gold as well. So it's going beyond the developing country central banks and monetary authorities that we've seen more recently. Now, one of the reasons behind that is central banks are not only responsible for monetary policy, they're very often responsible for financial stability. And when these central banks are producing financial stability reports spanning hundreds of pages, if they're getting a little bit worried about the state of the economy and financial stability, um, very often they've been making gold purchases. That's a nice historic trend that we've seen. It's not statistically valid. It doesn't sit in my model, for example. I have tested it, but anecdotally, you've seen some central banks time this very well. So if central banks are buying gold at higher volumes, especially developed central banks and monetary authorities, that could be an indication of some of their risks around financial stability becoming a little bit more elevated.
Nitesh, let's talk a little bit about the idea of a diversified portfolio. Now, most people understand the idea of not putting all your eggs in one basket and that you have to diversify. But of course, you can take that discussion further by understanding what function each investment in your portfolio actually serves. So you've outlined a little bit the case for investing in gold, but maybe just tell us a little bit about where gold sits within an investor's portfolio alongside other asset classes.
Yeah, so as I briefly mentioned earlier on, gold almost has this bipolar behavior. Um, it does extremely well in times of high inflation, which is often coupled with strong economic performance, because inflation is often the byproduct of a strong economy. When you got too much money chasing too few goods, as the saying goes, that when you got too in those scenarios, when you got a lot of monetary impulse, you tend to have strong economic outcomes as well. But it also does well when the economy is doing badly, when you and gold acts as that defensive asset. And canvassing many different assets, I can't see any other asset that acts in that way, where it does so well in both extremes. Most other asset classes have a kind of linear performance, right? Like cyclical assets, when the economy is doing well, they do well, and when the economy is performing badly, cyclical assets also perform badly. Defensive assets like say bonds, or especially government bonds, they tend to do well in economic bad times. That's when people flock towards a defensive asset. And then when the economy is performing really well relative to other assets, bonds don't do that well. Gold is in an asset class of its own. So therefore, when you're looking to diversify a portfolio, you want to add in assets that behave differently to others, gold is surely something to look at. Now, how much gold should ever go into a portfolio? And that's a very difficult question to answer. Some of our analysis shows it depends on what you're trying to optimize. If you're trying to optimize performance on its own, um, then you could go through something like 30% allocation towards gold when sort of optimizing just on the basis of performance. If you're factoring in the volatility of gold, so you're taking sort of a balanced view on on risk and performance contributions, maybe that would be a little lower. And it kind of really depends on your volatility, your tolerance. But if you're looking for say sort of 8% sort of volatility acceptance in a portfolio, even something as high as 10% allocation to gold could work quite well. And um, it's very clear that gold has done well in times of stress. And the thing is, we don't, times of stress aren't things that are easy to predict. Um, and that's just in the nature of things. And if you're using gold as a hedge instrument, so an instrument to hedge against economic outcomes, financial outcomes, geopolitical outcomes that you hadn't expected, then it's almost a situation where you got to keep gold. You should keep keeping gold as part of your portfolio all the time. That strategic role for gold. It indicates that gold should remain in a portfolio all the time. And just looking back at sort of recent examples, the COVID pandemic, for example, nobody could have predicted that event was going to happen. But yet, when it did, gold prices performed quite strongly. Um, and like with any insurance asset, um, buying the insurance after the event has occurred probably means the insurance is going to be expensive, right? It's already been priced in at that point. So keeping gold in a portfolio earlier is as a strategic asset is something that if you're doing long-term portfolio management, then that's something that's worth considering. And there's numerous examples. You got the pandemic, as I mentioned, Ukraine war last year, the banking sector turmoil that we saw a few months ago, and even they did this week. This past week, we've seen more stress in the banking sector with First Republic Bank. Um, Now, if we're thinking about risks going forward, anything could crop up. There's a lot of discussion right now about the debt ceiling in the US, for example. Now, we've seen debt ceiling negotiations take place in the past. Very often, the politicians, it's up to it's up to Congress and to actually raise the debt ceiling, but they all very often take it to brinkmanship. You only get an 11th hour deal, and what if that deal is not struck? What if there is defaults on some of US's debts? That would be a catastrophic event, and I would imagine gold prices could zoom up very strongly if that were to occur. And obviously, once again, positioning early is the best way to hedge against that risk.
So, Nitesh, we've talked at length about the notion of investing in gold physically, and you've contrasted that with investing in gold futures. One thing we haven't mentioned is the idea of accessing gold through the equity angle, which is if you were to invest in miners of gold. So, would you like to just say a few words contrasting the features of investing in gold miners versus the other ways of accessing gold we've touched on so far?
Yeah. So gold miners, bearing in mind what they're dealing with is pulling gold out of the ground and selling it essentially, processing and then selling it, you would imagine to have a strong relationship with gold. And it does. Gold miners have a strong gold miner beta. Um, but they also have a strong equity market beta as well. So you've got other things mixed in the in that investment opportunity. What we tend to find is miners do really well at the early phases of of a gold rally. Um, Very often, these miners are going through a belt tightening process during troughs. When market conditions are very difficult, and then when gold prices rise, the end output that they're selling is higher. Therefore, they're piling in a lot more. Therefore, they have a lot more margin power, and therefore the miners tend to do well in those kinds of environments. Over the longer term, we've typically tended to find that gold, as the physical gold, tends to outperform the miner. But if you try to time different points of the equity or gold price cycle, then you may find there's nice opportunities for investing in miners.
So, Nitesh, as we approach the end of our discussion in this episode, I do want to touch a little bit on this notion of ESG as it relates to gold. Now, in the world of commodities, it can at times be challenging to create an ESG framework, but it doesn't mean that the conversation isn't evolving. And with gold, certainly the conversation has evolved enough to incorporate this notion of responsible sourcing. So, tell us a little bit about the idea of responsibly sourcing physical gold and why it matters.
Yeah, I fully agree with you, Mabeen. In the commodity markets, the ESG is very difficult because there's not that much agreement on frameworks. But gold sets itself apart because um, it's a lot of the legwork has been done in past decades. So the London Bullion Metals Association had worked with the OECD to define responsible sourcing criteria back in 2012. And it's an iterative process. Every year or every few years, these standards have been improved a little on by little. And what we did find is in 2019, uh, ESG was formally included in the responsible sourcing criteria from the LBMA. So responsible sourcing has been around since 2012. 2019, you've got the formal ESG adoption, and then even since then, we've got come up with then the LBMA has come up with more criteria that strengthens this. And ESG, is multidimensional. There's environmental, social, and governance. A lot of the initial parts of responsible sourcing back in 2012 were really focused about anti-money laundering, those kinds of things. The formal adoption of ESG in 2019 expands on that. There's a lot, I guess, a lot of emphasis on the social and governance components. Knowing that sort of various countries where gold is mined in, can do with sort of help from these kind of these bodies to elevate the governance and social standards, and increasingly the standards are looking at environmental criteria. I mean, nasty chemicals had been banned even at the sort of many years ago, but even looking more, drilling more deeply into emissions and other chemicals that are used in the gold processing is becoming increasingly in scope.
So, Nitesh, as we wrap things up, we've discussed a lot. So, this might be the most challenging question of the discussion, which would be, what would be your single key takeaway that you would want to emphasize as we wrap things up in this discussion?
Yeah, I would say that given that gold behaves so different to other asset classes and is a very liquid asset class to access, it should be always considered as part of one's portfolio.
Excellent. Well, it fascinates me how your cash balance in your bank account is just a number on a screen. Your ownership of shares in companies or funds are numbers on screens, but people still value the idea of physical goals, something they can touch and feel, and won't just disappear in the event of any given system breaking down. But thank you so much, Nitesh. Fascinating discussion today. And thank you, everyone, for tuning in. We hope you've enjoyed today's episode of the Commodity Exchange. If you want to hear more from us, please subscribe on whichever platform you're using. You can follow us on Twitter at NiteshWT and at Mubin Tahir WT. And if you want to learn more about commodities, visit Wisdom Tree's website, where we have a wide range of research materials and insights. Until next time.